Banks profit exponentially off of almost everyone in America. Either they're lending you money to pay for cars, real estate, equipment, or college, or you're parking your cash safely inside their holding tanks so that hopefully you won't ever need any of their loans. Meanwhile, they're loaning out every single dollar of your savings multiple different times for a handsome profit, while they give you peanuts for the use of your capital. Either way, they win. Let's show you how to profitably run those exact same cash flows through your own private banking unit to build two assets at once and to get your money wearing multiple hats. In order to explain how to do this for yourself, we're going to dissect both of the ways that banks profit, using the example of college costs. Keep in mind, though, that this exact same model can be used by business owners investing in their business or by fiscally responsible consumers with their major purchases in life. Let's first look at traditional bank financing for ongoing college costs. You essentially borrow against your FICO score to qualify for the bulk of the capital necessary to acquire it. You then must make ongoing structured principal and interest payments to pay off that loan and get yourself back to even. You continue in this manner until all college costs are financed. But be very clear about the fact that there is no guarantee that banks will continue to make this liquidity available to you. If it's a soft economy, or if, for whatever reason, the bank doesn't share the same vision for your college costs, they can just pull the plug on your financing. This is all the more reason to save up your own cash so you don't need to rely on bank loans. Let's face it, some people simply hate the concept of borrowing, even if it helps them exponentially acquire more assets. They would feel better paying cash for every single college expense and not being on the hook to anyone. Well, in order to do so, you first have to save up enough capital in a bank account that earns very little or no interest. Because of this, the payment structure you have is nearly identical whether you pay cash outright for college costs or you finance them 100% using bank loans. Now, some of you may be saying, wait, when I pay with my own cash, at least I don't need to pay interest for the use of the bank's money. True, but remember that you are passing up earning a reasonable interest rate on your own capital by keeping it safe and accessible inside their coffers. In fact, you're voluntarily not gaining any ground whatsoever on this very large block of liquid assets in between financing each student's college experience. Even if interest rates go up considerably in the future, you wouldn't be able to take full advantage of it, because as soon as you get your account to the point of critical mass, you kill your compound curve each time you withdraw that cash to pay for another year of college. And it doesn't need to be that way. I'm going to show you how to create a money multiplier effect with your own bank account by keeping your liquid reserves safely and continuously compounding for you, even though you have them doing double duty elsewhere. You see, in a perfect world, you'd save up assets one time and they'd go ahead and compound into the future. What's so powerful about compounding is that you not only earn interest on your principal, but pretty soon you earn interest on the interest through principals already earned. It creates this wonderful snowballing effect. That's why the curve on the right is a lot steeper than on the left. In fact, when I ask clients, which side of this curve would you rather have? Everybody wants the steeper side on the right. But you don't get that without putting in your time on the early part of the curve. You see, it's just the time value of money. Keeping assets continually compounding over time is the key. Unfortunately, though, these purchases do need to be made. Every time they are, it just resets our compound curve to the very beginning, killing our chances of ever getting to the far right-hand side of that curve. That is, unless there is a way to contractually borrow against our assets at any time for any reason. You see that when we do, that red line comes down, indicating there's a lien against our asset base. But notice that the entire asset base continues to compound up that green curve. As we pay down the lien against the assets, we actually end up at a higher place in line each and every time. That's really the biggest component of this strategy, the fact that your entire asset base continues to compound in your favor, in spite of having used some of it to make those purchases. Now, it helps, too, that the asset class we've chosen also happens to grow each and every year at a very favorable rate of return, a return that does not start with a dot. It's also immune to market losses and immune from taxes. All of these things work in its favor. Keep in mind that the cash flow and payment structure we're using is an apples-to-apples comparison with somebody paying cash. You don't have your entire asset base compounding for you when you withdraw cash from an account to make a purchase. In fact, you'd need such an astronomical rate of return to make this work and to overcome any taxes due that it simply pales in comparison to how effective the banking strategy can be.